At minimum, you want to not be emotional and not succumb to the cycle.
How about your health?
Very good.
It's good?
Well, getting
Okay.
better. I believe that there is a realization that keeping interest rates super low forever. I look forward to interviewing with you both in 20 years.
How are you?
I'm good. How are you?
It's good?
Yes, very good. Very good. All is well.
Okay, thank you very much for inviting me
Sure.
this morning.
Thank you for coming to see me. You can't cuddle up with your money. It's not going to keep you warm at night. Money is, it's just a scorecard. You know, when you get to the point where you have more than you need, the rest is just a scorecard. My first book was called The Most Important Thing. It's not money. I love to invest. I'm 77 years old. I'm still going to work and part of our organization. I would say at this point not to make more money, but it keeps me thinking, it keeps me active. The most important thing in the world is having loving connections with friends and family, in my opinion.
자, 삼프로TV 시청자 여러분, 그리고 늘 저희 삼프로TV의 컨텐츠를 성원해 주시는 투자자 여러분, 오늘 아주 특별한 게스트와 함께 할 텐데요. 여러분 기억나시죠? 작년 11월에 삼프로TV 저희 본사의 스튜디오를 찾아주셨던, 그리고 지난 5월 달에 뉴욕의 오크트리캐피털 본사 컨퍼런스룸에 저를 초대해 주셨던 채권 세계에 글쎄 뭐라고 할 때, 저는 그냥 감히 주식에 워런 버핏이 있다면 채권에는 이분이 있다. 오크트리캐피털의 하워드 막스 회장께서 다시 서울을 찾아주셔서 제가 특별 인터뷰를 준비를 했습니다. 정말 하워드 막스의 메모라는 글을 여러분 읽어보셨는지 모르겠지만, 저는 그 글을 읽을 때마다 저희의 투자에도 그렇지만 저희의 비즈니스 그리고 저희의 인생에도 굉장한 인사이트가 있는 글이 아닌가 그런 생각이 들어요. 그래서 오늘은 특별히 하워드 막스의 몇몇 메모에 나오는 그 인사이트에 집중해서 인터뷰를 좀 해보려고 합니다. 정말 반가운 얼굴고 그리고 건강한 모습으로 우리 앞에 다시 오신 하워드 막스 회장을 소개하겠습니다. Hi Howard, thank you very much for your time.
Thank you. It's good to be with you today.
Before we start, could you say hello to our Sampro subscribers as well as Korean investors who have been eagerly waiting for interview with you?
Well, I'm glad to say hello today and to have you with me. And Jacob and I have been working on these videos for a couple of years, and they're most enjoyable. Glad to be here again.
Let's kick this off with our first question. You may remember during our last interview, you showed us a framed bank notice from 1980. 1980년도에 하워드가 대출 이자 청구서를 받았는데, 이때 대출 이자가 말씀드린 것처럼 22.25%. 그래서 그때 하워드 생각에 이거는 다시는 오지 않는다라고 생각하고 여러분 보시는 이 액자에 그 청구서를 담아놨다고 합니다. 그래서 제가 하워드께 요청을 드렸습니다. 2020년도에 받았던 2.25%도 청구서도 이거와 똑같은 프레임에 넣고 다음 인터뷰에 꼭 한번 보여달라. 그래서 했더니 11월에 한국에 오셨을 때 또 인터뷰를 할 거고, 그때 그 액자를 가지고 오겠다라고 얘기를 하네요. Did you end up framing the 2021 at 2.25%?
Well, I haven't framed it yet, but I have found it, and that's the hard part. And so I'll print it out, I'll get it framed. But obviously, the combination of the two tells a great story. And it is really, in my opinion, the decline of interest rates by 2,000 basis points from 1980 to 2020 was the biggest single financial event of the last half century. Most people don't think so because it took place gradually over a long period of time. It wasn't as dramatic as the meltdown of Lehman Brothers or the global financial crisis, but it was highly influential and has changed markets significantly.
Right. In your memo to Oaktree clients, you have used the term sea change to
Right.
refer to significant
Yes.
shift in the financial landscape. What do you consider to be the most pivotal sea change events?
Yes. Well, a sea change is a change which is fundamental, significant, and probably long-lasting. I've been in this business 54 years. I've lived through 2 prior sea changes. This is, I believe, the 3rd. The first was 1978, when people revised their thought process. Before that, they looked for high-quality assets. After that, they said, no, we'll buy low quality if it's cheap enough to compensate for the risk.
Right.
That was a change. And that change has considered to today. Today, nobody says, no, it's low quality, we won't buy it. Today, they say, it's risky, but it offers a high enough return to compensate, so we'll do it. The second change was the retreat of interest rates starting in 1980, when interest rates turned down. And that set off this 40-year decline in interest rates, which has made a lot of money for asset owners and for borrowers, and especially for people who own assets with borrowed money. This was a perfect environment for that kind of operation. The essence of the sea change memo is that it's over. So what the memo said, what the 3rd sea change is about, is that anybody who came into this business or entered into investing since 1980, 43 years, has only seen declining interest rates or ultra-low interest rates. And what people do is when they see something for a period of years, they tend to think that that's normal, and it'll always stay that way. But I believe that's not true in this case. I believe that the period of ultra-low interest rates is over, and that has very significant repercussions for which investments will do well and which will do poorly.
Right. Well, we often say this time is different.
Yes.
To rationalize high valuation.
Yes.
How's the different from your concept of sea change?
Yes. Sir John Templeton, who was a great investor in the last century, maybe the 1980s, said that that people tend to say this time is different, as you say, to rationalize unusual valuations, and that gets them into a lot of trouble. But he also said that 20% of the time, things really are different. And I believe that this is one of the times when it really is different. And clearly, with the Fed funds rate now at 5%, there's not that much room left for a decline.
Right.
And I think there are conditions in place which will cause the Fed to maintain interest rates in the vicinity of where they are.
Right.
One of these days, the Fed will declare victory against inflation, and it will be able to lower interest rates a little bit to stimulate the economy. But I think, I make a statement in the memo that in the 5 or 10 years ahead, the Fed funds rate is more likely to be between 2 and 4 than between 0 and 2. So that's a bold statement for me because I don't believe in forecasts. But I think that interest rates were ultra low in the period I discuss in the memo, 09 through 21, and I think that they're not going to be that low in the period going forward.
Right. So we have to prepare
Yes.
some different situation, right?
Yes.
So interestingly, we are in a period of rapid economic change. Your analogy of the moving walkway seems spot on.
Yes.
What do we as investors need to be wary of in adapting to this rapidly evolving environment?
The environment has a profound effect on what works and what doesn't. And for the 40 years, and especially for the 13 years from 09 through the end of 21, investors received a tailwind, help from the declining rates. Declining rates stimulate the economy, increase consumer demand, drive business to companies, make companies more profitable, make assets more valuable, reduce the cost of capital, make financing readily available to companies and cheap, and make it easy to avoid bankruptcy and default. In other words, an easy period. It was very easy to succeed. And this was very good for asset owners and borrowers. And of course, great for somebody who owned assets with borrowed money. And if you accept that that's over, that we're not going to be in a period of declining and ultra low interest rates in the next 5 to 10 years, then other strategies will be the preferred ones. So, I mean, the first question is, do you agree with my thesis about interest rates? Each person has to make that decision for themselves. But if it's true that we have this change, then people have to say, well, what are the strategies that will do well in the new environment? And for the 09 to 21 period, interest rates were extremely low, the lowest probably in history. The Fed funds rate averaged 0.5%, which is extremely low, unnaturally low. So investing in debt securities, which is most of what Oaktree does, was not rewarding. A year and 3/4 ago, high yield bonds yielded 4%. Not very desirable. Today they yield more than 9%.
More than 9%?
Yes.
In the state?
Yes, in the States, in dollars. So that's a big change. And all along the spectrum of debt, or what we call credit, the available yields are much more satisfactory today than they were in that period. And the impact of the sea change is that I think people should consider investing in debt securities. Today, investors can get equity-type returns from debt, and debt, which consists of a promise to pay, is much more dependable than equities, which have no promise. The S&P 500 index returned about 10% a year on average for the last century. That was enough to turn $1 into $14,000.
Right.
And today, debt securities offer, as I said, high yield bonds in the 9s, private debt, hard for the individual to access, in double digits.
Double digit.
So that means equity type returns. And that's a wonderful thing that has been missing for a long time. And I'm thrilled to see that it has returned.
So you mean we don't have to invest in equity market in this situation? The high yield bond rate is over 8% per annum.
Now, Jacob, stocks are great. Stocks permit investors to participate in the growth of the economy and the success of leading companies. And I'm not saying that your subscribers should sell all their stocks, but maybe part and move into debt instruments at this time. I think that a balanced portfolio is attractive today, whereas in the period that I'm talking about, an investment in debt instruments would not have been very helpful.
Right. So let's go for the new environment. for investment. Many investors today, given their age, haven't experienced the high interest rate periods. In preparation of changing times, how should we differentiate our investment strategies between periods of low interest rate and period of rate hikes? What is the most effective investment strategy during a period of interest rate hike like this?
Yes. Well, first of all, let me clarify for your subscribers that we don't really have high interest rates today. We have normal interest rates. The rate was abnormally low for that period 09 through 21.
You mean that we have to change our mind to...
Well, you know, the great American economist Paul Samuelson, who wrote the economic textbook that that I used when I was a student, most do, said, when events change, I change my mind. What do you do? And, you know, when the environment changes, we must assume that a new approach is needed. Einstein says the definition of insanity is doing the same thing over and over and expecting a different outcome. I believe that another definition of insanity is doing the same thing in a different environment and expecting the same outcome. So equities and levered investments, investments made with borrowed money, worked extremely well in the period of declining rates. They clearly should not be expected to work as well with steady rates and with higher rates. People buying assets in that period were able to borrow money very cheaply and substitute the borrowed money for their own money to amp up the returns on their investments. We call that leverage. The key is the cheapness of the borrowed money. And if the borrowed money is not available as cheaply now or in the future, then leverage strategies will not be as successful. That's like math. It's logic. There's no supposition in that. And so I mentioned the effects of the favorable effects of declining interest rates. What about stable and normal interest rates? Well, I think that economic growth will be slower, business will be slower, company profits will be less, profit margins may be under pressure, assets will not appreciate as dependably, the cost of capital will not be so low, and it will not be so easy to avoid bankruptcy and default. So, in other words, we went through an easy period, and I believe we're going into a harder period, not catastrophic. I'm not talking about a depression. I'm not trying to worry anybody, but life will not be as easy. And so investments like equities and leveraged, private equity is a great example of a leveraged strategy. These may still do okay, but they should not be expected to do as well. Debt, which was unsatisfactory in that period because the yields were so low, will be much more satisfactory in the coming period. You know, if you buy a high yield bond that pays 9%, you have a promise of payment. If the company keeps its promise, which the overwhelming percentage of companies do, you'll make 9%. There's no doubt about it. And that's a wonderful thing. So I think that now debt securities can play a useful part in most people's portfolios, whereas in the 09 to 21 period, they could not.
But I have some news from the state. Bankruptcy rate went up. I'm not sure it's dramatically or not.
Yes.
But in this situation, high yield bond is still available to invest because bankruptcy.
Yeah.
How do you think about that?
Well, look, I was very fortunate, as you know. I was asked by Citibank to start their high yield bond activities in 1978. And 1978 was the beginning of the high yield bond world. Now, most of your subscribers were born since 1978, so they may think that there always have been high yield bonds, but they're new, only 45 years old. We have always had bankruptcies and defaults. It's part of life. It happens that in the easy money environment of the last 13 years, the default rate was unusually depressed because the environment was unusually easy. In the new world, bankruptcies and defaults will occur again. By the way, over the last 45 years, on average, 4% of all high yield bonds defaulted on average each year. But we get paid enough extra interest to make those risky investments that the investments were still satisfactory. So the mere fact that there are defaults and bankruptcies does not disqualify this as an attractive area for investment. I use the analogy to life insurance. How can life insurance companies insure people when they know they're all going to die? And the answer is, it's a risk they're aware of. It's a risk they can analyze. It's a risk they can diversify, and it's a risk that they're highly paid to take. So those four things, in my opinion, are the criteria for the intelligent bearing of risk for profit. And that's what we want to do. As an investor, I have no interest in avoiding all risk. If you avoid risk, you probably avoid return. What I want to do is take risk intelligently, where I'm well paid to do so. And that's the history of high yield bond investing. And we've been doing it for 45 years. We've lived through a period when defaults averaged 4% a year, and we've been very successful. By the way, in that period, there were 5 years when the default rate was 10 or more. 1990, 91, 01, 02, 09.
Right.
And yet, we were still successful. Those years may have been a little painful, but over the entire period, investing in high yield bonds has been very successful.
Right. Let's change the topic a little bit. You talk about learning in own lesson from history. When it comes to investing, what's an important lesson you have learned through the history you have lived through?
I think one of the most important lessons is that you have to that investing is not a mechanical activity where the performance of the economy and the performance of the company translates directly into the performance of securities. Most people think that if the company does well, the security will do well. If the company does poorly, the security will do poorly. But they miss the fact that there's a step in between, and that is investor reaction. How do people feel about the progress of the economy and the company? You see, so for example, you can have an announcement of an earnings increase and the stock goes down. Why? Because people are disappointed. The earnings were up 10%. They thought it was going to be up 20. So they feel that the company is underperforming, stock goes down. So that's an important lesson. The role of psychology. And the ramification is that you must be conscious of the environment, psychological environment, when you are an investor. So I said in one memo that in real life, things fluctuate between pretty good and not so hot. But in investors' minds, they go from flawless to hopeless.
Right.
And the swing of the pendulum is highly exaggerated. So when the pendulum swings positively and everybody feels good and is thrilled about what's going on and is optimistic about the future and excited, usually security prices go too high and become dangerous. And if you can detect that, you might want to reduce your
Right.
investments or move to safer investments. Then eventually the pendulum swings, and now people are too depressed and too panicky and too pessimistic. And they think that we're going to have bad times forever. And when that happens, usually the prices of investments collapse. That's a great time to buy. So in the short run, psychology is more important than company fundamentals. And it's not correct to say good events are coming buy, bad events are coming sell. Rather, market is too optimistic, sell. Market is too pessimistic, buy. What matters is not the quality of the thing you're investing in, but whether the price is high or low relative to the intrinsic value. And it's from the fluctuations of price around the intrinsic value that dictates the performance in the short term. Now, if you're a real long-term investor, and if you're 25 years old, and you say, I'm going to hold this for 40 or 50 years, which is the right attitude in many cases, then you can ignore psychology swings. Because in the long run, if you hold your investments, your return will really be dependent on the fundamental behavior of the company. Ben Graham, who was Warren Buffett's teacher,
Right.
said that in the long run, the market is a weighing machine, and in the short run, it's a voting machine. In the short run, the movement of price is determined by movements of popularity. In the long run, movements of price are dependent on the performance of economies and companies,
Right.
what we call fundamentals. So every investor has to figure out whether they're going to be short-term oriented and buy, sell, or long-term oriented and mostly hold. Of course, you can be somewhere in between. You can not trade every day, which I argue terribly against, but you can make occasional changes in your portfolio when warranted, as I believe they are now.
But I don't know why whenever I heard the insight like this, we can do that. I will follow your insight. But every single individual investor, they can't change
Right.
to right direction.
No, they can't. It's very, a friend of mine wrote a book about investing. The title is Simple but Not Easy. The things we want to do are simple to describe. The investor wants to hold more of the things that will do well and less of the things that will do poorly. Very simple. Executing is not easy.
Right.
It takes skill to know what will do well and what will do poorly. And nobody should confuse themselves. And when I speak to you and to my other close associates, I always stress, I don't want to make investing seem easy. I want people to understand how hard it is so that they don't try anything too adventurous. I published a memo this summer called Taking the Temperature.
Right.
And I talked about 5 market decisions that I made starting in 2000. And all 5 were correct. Sometimes it took a little while for them to be correct, but eventually they were all correct. And I describe how I did it. And I did it not based on data, but based on my sense for the environment. By the way, for example, Oaktree and I turned negative in 05-06 because we were worried that the market was behaving in a rash manner, taking too many risks. And that when other people take risks, it makes the world a risky place for me. Now, shortly later, we had the global financial crisis, which was a problem with subprime mortgages and mortgage-backed securities. And you know that Merrill Lynch, Bear Stearns, Lehman Brothers all disappeared.
Right.
It was the worst environment I've ever seen. We managed to largely avoid it. Why? We didn't know anything about subprime mortgages, but we knew that the world was a risky place. So that's why I say take the temperature of the environment, but not easy. At that time, I had been working for 40 years. I had a lot of experience, so I could recognize what was going on in the environment. Somebody with less experience really did not have the ability to do that. So, look, investing is a great thing. Over a long period of time, investing will turn a little bit of money into a lot of money if you don't screw it up. But nobody should think that frequent, correct market timing is easy.
So the investment's not that easy.
It's not easy, but it's still very important. One of the implications is that most people should get help. Most people should not pick their own stocks or decide their own market timing. Most people should buy managed funds or index funds. Managed funds actively select investments, buy this, sell that, trying to have more of the things that do well and less of the things that do poorly. Index funds are passive. They just hold a diversified basket throughout without buying and selling. Either of those is better for the average investor than trying to do it yourself. Most people don't do their own legal work. They don't do their own medical work or their own dental work. Most people don't even fix their own cars. And yet, so many people think that they can do their own investing. What the individual can do is put aside money, set a course, and hold to it. But in most cases, the individual selection is better left to a professional.
So, you and Oaktree are synonymous with value investing, and your recent memo suggests a constant reassessment of portfolio allocation.
Yes.
At what point is it necessary to consider reallocating capital, and what key factors should inform this decision?
Well, that's a very broad question, Jacob, a very good question. First, the investor has to say to himself or herself, what will be my approach to investing? Will you could establish a portfolio today and leave it alone for 50 years. And you will benefit from the long-term performance of the economy, the corporations, and the market. Or you can be activist and try to make frequent changes in your allocation. So I can't say what all your subscribers should do. It's an individual decision. They have to decide on the basis of their own expertise, how much time they want to devote to the process of investing, how much risk they want to take, whether they have dependents, whether they have enough money that they could stand to see decline for a while, because declines are part of life in the investment world. And what is their attitude toward risk? How strong is their stomach for living with fluctuations? Different for everybody. So I think that for the non-professional investor, the most important thing is invest for the long term. Don't be too active, because, our psyches try to get us to make mistakes. They try to get us excited when things go well and buy at high prices. They try to make us depressed when things go badly and sell at low prices, which of course is the opposite of what one should do, and but it's common. That's why we have highs and lows in the market, because psychology becomes too favorable and then too negative. The key is to power through for the long term, not succumb to the short term, and not try to outthink the short term, because most people can't do it. So, as I say, save money. Don't spend all you make. That's the most important single thing. Put it aside, invest for the long term. Don't succumb to psychological excesses. Once in a while, you might try to make a change in your allocation when it is demanded. I think today is such a time. You know, anybody who has a portfolio of all stocks for the last 10 or 20 years did very well. I think that all stocks is not the right portfolio for the next 10 years. For the next 10 years, they should have a balanced portfolio with stocks, but also a large component of debt or credit. I think that's the right thing for the new environment. Exactly how large that component should be is different for everybody.
Right. Maybe this question will be last one. Technological advancements serve as a fundamental catalyst in the investment landscape. In your view, is cryptocurrency, particularly Bitcoin, a short-term speculative asset, or does it signify a fundamental transformation driven by technological progress?
Well, you have summarized the debate. Nobody knows the answer. All we have is opinions. Earlier in our conversation, you said that Oaktree and I are value investors. What does a value investor do? A value investor in, let's say, stocks, considers himself or herself to be an owner of the company. These are not pieces of paper that we trade to make money. These are ownership shares that we want to hold in the long run because we think we want to be part of that company. The value investor tries to figure out what the profits and cash flows of the companies will be in the coming years, and tries to turn those estimates of cash flows into a intrinsic value today, and then looks to see if the stock can be bought at a reasonable price relative to the intrinsic value. Growth investors actually do something similar, but their time horizon is longer. They invest more on long-term trends, but of course when you think about the long-term future, you can't have a high degree of correctness, and you have to have what we would call a hunch about whether a certain technology or product will do well 30 years from now. But these forms of investing are based on analysis and projection of the future. Bitcoin or other cryptos, there's no such thing. There are no cash flows with Bitcoin. It's not a productive company that will throw off cash in the future. It may serve a purpose in the financial system of the future. That may or may not make it more valuable than it is today, and there's no place to look for the answers. So I believe that it's contradictory to say I'm a value investor in crypto, because you can't try to figure out the value of crypto. It has no backing, it has no assets behind it, and it has no cash flows. So that leaves us with the other term you used, speculation. Now, usually the term speculation is used to describe an unwise investment. I'm not saying that crypto is necessarily unwise, but what I'm saying is that speculative investment is the opposite of analytical investment. And as I mentioned, I think there's no such thing as analyzing the future of Bitcoin or crypto. We don't know, and you can't know. So it's all just a matter of opinion. And if you have a positive opinion, you can buy it. And if your positive opinion turns out to be correct, you may make a lot of money. And if it turns out to be incorrect, you may lose all your money, because crypto could turn out to be valueless. So, speculation, betting on the future without analytical foundation. But I can't tell you that it's unwise or not to do it. In 2017, I wrote in one memo that I thought that that crypto had nothing behind it and was speculative and unwise. I still think that's true. But Bitcoin was $10,000. Today it's $35,000. This year, it's probably the best performing asset.
Right, double up.
Yes. So my son, who is more open-minded and less constrained by old age than me, he says, "Dad, it's been around since 2008.
His performance is better than yours.
His is better.
This year.
That's right. But it's been around for 15 years. If it was a scam or if it was an empty promise, wouldn't that have been exposed by now?" And the answer is yes, that's a good argument.
Right.
And in 2020, it went from 4,000 to 75,000. And then in the next year, it came way down and it fell to 17,000, from 75,000 to 17,000. But this year, it's gone from 17,000 to 35,000. We all have our opinions, and we're entitled to our opinions. The key question for any investor is, how much money are you going to bet on your opinion? And clearly, the story has not been written with regard to crypto. I will say that the fundamental argument in terms of crypto was what we call a use case. That is to say, there are uses for crypto, and people will start doing business in crypto and banking on the blockchain, where they don't trust the banks or the government, or they don't want other people to know how much money they have, or where they want to make transfers of cash in civilizations where it's hard to send money. I think it's fair to say that the use case has not been validated yet. And crypto's 15 years old, but I don't think many people are doing business in crypto yet. So all we can say is that the use case has not been proved out. It remains a speculation. But I wouldn't bet my life that it will end up being a bad investment.
Okay, can I give you one more question?
Yeah, it's okay.
Okay. I think similar situation over the world, especially in Korea. Every young generation, they want to be millionaires, they want to be rich people. I want to give us your advice. What is the most important thing for our life? Money, health, relation?
Well, clearly, I know a lot of people who are very rich and spend all their time trying to get richer. And some of them have poor relationships with their family members, and not many friends, and not many other interests. And all they try to do is get richer, and some get richer. For me, I mean, each person has to decide what's right for them. But for me, that's not enough. And when you get to be my age, and you say, am I happy with the way I lived my life? Am I happy with where I am today? You can't cuddle up with your money. It's not going to keep you warm at night. And money is, it's just a scorecard. When you get to the point where you have more than you need, the rest is just a scorecard. And it shows whether you were a smart business person or not. But being a smart business person is not the most important thing in the world. The most important thing in the world is having loving connections with friends and family, in my opinion. And also, Jacob, other interests. We talked before about golf, not my interest, tennis, which I love, and art collecting and travel. These are important too. You should have a well-rounded life. If your goal is to be the richest person in the world, then you're probably going to be unsuccessful because there's only one. And investing is fun when it's successful. It's not too much fun when it's unsuccessful. And if you invest well, you'll pile up more money. It's just that it's not the only thing in the world. My first book was called The Most Important Thing. It's not money. I love to invest. I'm 77 years old. I'm still going to work and part of our organization. I would say at this point not to make more money, but it keeps me thinking. It keeps me active. There's nothing more rewarding in life than tackling an intellectual challenge and being successful, and thinking things out and understanding things better than others, and reaching answers that are correct.
Right.
All these things are very rewarding, and they don't have to have anything to do with money.
Right. Howard, thank you so much for sharing your insight today. We wish you a wonderful stay in Korea and hope to see you next year and beyond.
Absolutely.
On behalf of our viewers and subscribers, thank you again.
It's my pleasure to work with you. I enjoy our partnership, and I too look forward to the future with you.
Thank you very much. See you next year, early next year, hopefully.
Good.
Thank you very much.
Thank you.
자, 여러분, 이번에도 하워드 막사 회장께서 정말 여러분들께 특히 우리 개인 투자자 여러분, 그리고 투자에 조금 익숙하지 않은 젊은 분들에게 굉장히 의미 있는 조언을 주신 것 같습니다. 삼프로TV는 앞으로도 이 하워드 막스 회장과 같은 정말 인사이트풀하고 그리고 정말 실전으로 그 투자를 실천하신 여러 글로벌 투자 구루들을 여러분께 소개하려고 합니다. 많이 기대해 주시고요. 이번에 하워드 막스 회장과의 인터뷰도 여러분 많이 봐주시고 또 주위에도 많이 알려주셨으면 저희의 이런 노력이 헛되지 않을 것 같습니다. 오늘도 시청해 주셔서 감사드리고 다음에 또 좋은 인터뷰로 인사드리겠습니다. 여러분 고맙습니다. Thank you.